Welcome back to QAV, TK. Episode
Thanks.
834, QAV Australia. People don't know that you had a week off, but you had a week off.
Now you told them.
Oh, whoops.
I was there
Tell
last
us
week.
what.
I was
Tell us
interviewing
what
John
you.
Abernethy.
Sure you were. Tell us what you've been doing.
Oh, I went away, had a vacation up at Yarrawonga on the Murray. I was going to save it for after hours, but that's fine. It was a lovely, lovely week away with Ruddy and my brother-in-law Wal. Playing golf. We stayed in just a fantastic Airbnb in Yarrawonga. A couple of streets from the main drag, a couple of streets from the lake. And it was a really nice house and super cheap. Stayed in this kind of Victorian, wouldn't call it a mansion, I suppose, but it was very flash and spacious. And we had a great time. Good fun.
That's nice. I'm glad it was super cheap because I wouldn't want you to be financially burdened with your golfing vacation.
No, well, it wouldn't have worried me, but I wasn't the only one staying there.
Right. Well, speaking of super cheap auto are not in my good books.
Really? Why?
I did a
They're
TikTok
mine.
about them. Well, I did a TikTok the other week that did quite well. I had to get a new headlamp for my car, and I went to Super Cheap Auto to get one. And I was looking at the one that I got to get, and I pulled out GPT and I said, "Is this a reasonable price?" And it was like, "No, that's ridiculous. You could get it for half that at Bunnings." So I had to go to Bunnings anyway. So I went up the road to Bunnings and got a bulb for half the price, and posted the because I'm trying to do this more sort of GPT related content, and how to use it in a shopping or retail environment. And a lot of people were like, "Yeah, super cheap is super expensive. Don't ever buy anything for super cheap. It's the worst piece of branding malarkey ever." So there you go.
Oh, you always market your worst aspect because the good things market themselves. We were up at
Oh,
Yarrawonga on the day that their results dropped last week. And
oh yeah.
and the share price went up, I think, something like 13 or 40, maybe 15% in a day. And
Right.
they're in my portfolio, so I was cheering them. And we're walking down to the main street. I just told Ruddy this, and on the corner of the street we were walking into the main street was a super cheap.
Mhm.
So Ruddy said, "Stick your head in and say thanks."
uh,
I stuck my head in, there was no customers, so I thought, "Oh, that's not good."
SUL, aren't they? Is that
SUL,
their code?
yes. Yeah.
Not in any of my portfolios. How come you have hold them and I don't? I must have sold them at some point.
Don't know. I've had them for a
You
while
don't.
now.
You don't sell. So
Yes, I
you're
do. I haven't sold
amusing.
much. I haven't sold for a while yet. Yeah, but they also own Rebel Sports and BC
Mm,
and
mm,
MacPack, I think.
mm.
I haven't gone through the results in detail yet to see what the split of revenue is.
I did have them in my super portfolio, but I sold them at some point. Don't know when, but it was a while ago. Well, there's been a lot of disappointing results and news and stuff that we'll get into. But before we get into that,
A lot of positive ones too.
ASX.
Hang on.
Well, yes. Yeah, it goes both ways.
It
The
does.
ASX up over 9,000
Mm.
for the first time. It's come back a little bit today, yesterday it hit 9313. It's back down to 9212 at the moment. A lot of boisterousness, a lot of markets booming, Tony. It's been a interesting couple of years, huh?
Yeah, we had this discussion probably about 12 months ago when it went through 8,000. And we got questions about, was the market overvalued and what's my strategy for dealing with an overvalued market? I'm just like, let it go. We've got our cells and we're not using them. And so we're faced in the same situation again. More record highs, more overvaluation, but we can't predict the future. So we're just going to keep the process going.
Went through 8,000 in February 2024, nearly 18 months ago. Went through 7,000 in January 2021. So, it had been through that before in 2019, briefly, just before the COVID crash. But yeah, it's going gangbusters.
And look, it's it. For I think the market is in overvalued territory. I think the market in the US is in overvalued territory, but they can continue to go on at this rate before they correct. And when and if they correct, we'll have our reasons to sell. Trigger them, we'll sell, but trying to predict whether it's going to be overvalued and then that leads to a crash next week is impossible.
I'm in the market, not timing the market, as you once said. I'm giving you that quote.
Oh, right.
As Tony Coniston once said. Hey, a couple of weeks ago, I built a spreadsheet of my QAV America pulled porks to see how they had performed since doing it. I did the same for your pulled porks going back to 2022. And I have a reference now because we talk about the curse of the pulled pork.
Mm-hmm.
Do you want to know what the best and the worst have been?
Sure.
So this is since the date of the pulled pork, right?
Mm-hmm.
The worst, apart from a few that have delisted, 5 have delisted: AGG, TAB, ABA, and FSF. Only 4 that have delisted. The worst performer outside of those is Core Lithium, CXO, that you did in December 2023. It's down 65% since then. Mineral Resources that you did in April 2023 is down 57%. Pilbara Minerals down 53 since May of 2023. DGL Group down 52%. Frontier Energy down 51%. Lindsay Australia, who we will be talking about later on, down 44% since you did it in July of 2023 when they were trading at $1.38. But have done quite well in my portfolio. So I must have bought them well after that, and they've done well, although they've come back a bit lately. Septire, is that how we decided to pronounce that? You did back in May of this year.
Yep.
CTT, they're down 41% since you did that. Air New Zealand, AIZ, down 31%. So there's a lot that are below water. That said, a lot of ones that have done very well too. Findy did them back in January 24. They're up 260%. Austell, ASB, you did in April 24, up 184%. Stealth Group, May 24, they're up 183%. Regis Resources, you did in December 23, up 165. Southern Cross Electrical, up 152. Service Stream Limited, up 142. Regis Healthcare, up 127. E-Road, up 127 also since December 23 when you did it. McMahon Holdings, up 121. Genus Plus Group, up 114. Metals X up 113, Nick Scali up 112, Ramelius up 100, Parenti up 95, lots. There's a lots above water. So I think there are more above water than below water, and the ones that are above water are way more above where they were when you did it than the ones that are below are below. But, it's probably, 60-40.
Which is what we always say. 6 out of 10. Yep.
Yeah. But the ones that have done well have done really well.
Yeah.
Not all of them. There's some here. Grain Corp, which you did in June 23, is up 5% since you did it. Macmillan Shakespeare, you did in November 23, is up 2% since then. So some have been shakier. But anyway, there you go. So the pulled pork curse is not a curse, it turns out, after all.
Just a couple of comments on that. And of course, they don't include dividends. So a company like MMS, I think, is yielding, I'm going to say, close to 10%. So in a couple of years of that would help. And of course, some of those ones that were underwater were lithium stocks, and we have cells, which would have got us out long before they would have been going down, but they wouldn't have gone all the way down. Numbers you quoted.
So there you go. That was a bit of fun.
Mm.
I've been asking ChatGPT how to improve QAV, Tony. it's at a stage now where I'm like, with its deep research, its deep thinking, ChatGPT 5, I'm like, here's all the metrics that we measure. What are we missing? Or the next step will be, here's how we're scoring them. Should we adjust the scoring, and how do I build a regression system to test that? The first thing it came up with was testing gross profitability. It suggested that one of the best documented metrics in academic research is gross profitability, which is gross profit divided by total assets. Novi Marx's 2013 paper showed that within value portfolios, high gross profitability stocks dramatically outperformed low profitability ones. The idea is simple. If two stocks are equally cheap, buy the one that's a better business. So I started thinking about that, but then thought, well, that's probably in one of the financial health metrics that we look at. And sure enough, it is in Stockopedia's quality rate. Long-term gross profits to assets is one of the things that is one of the components of their quality rate. I'm not sure about the Stock Doctor Financial Health, but I know you know those, or you used to know those a bit better, but I assume it's already factored in, or something similar to that is factored into financial health. But then the
Yeah.
question I had was,
Sorry.
should we be scoring on long-term gross profits or gross profitability differently? Should we be if that's one of the most important metrics in a value portfolio, should we be breaking that out or scoring that more highly than we currently are? And I thought I'd throw that out to you and see what your gut reaction is.
And the only way to tell is to test. And I guess the paper you quoted may have some numbers in there which would help us. My gut when I saw the notes this morning before coming online was that putting anything over assets can be a bit tricky because assets, first of all, it will favour capital-light businesses. So if you compare two companies with the same gross profit, I'm just going to pick two here, pick Myer, the department store business versus Amazon, where there's hardly any, there's much less in the way of assets. Amazon's going to look better, so that's probably a good thing. But there's also, again, assets can be manipulated. So there's been a lot of, I guess, research, a lot of things that have happened on the asset side of things. Going back to an ROE and ROA were two prime measures of value in companies in the 80s, 90s, back when I first started investing. And management would therefore focus on reducing equity, because if you reduce the denominator, then the percentage goes, oh, no, sorry, what's the bottom one? The numerator. What's the bottom part of the ratio? Anyway, if you reduce the below the line number in a ratio, then the overall result looks better. And so if you reduce equity by taking on debt, ROE looks better. And if you reduce assets by, for example, selling them and leasing them back, was the classic way in retail, your ROA would look better. But you'd have the same return, but you'd have less assets. And so I was always skeptical of anything over assets because it can be manipulated. So then you get down to what's a better business? Is it something like a Harvey Norman where they own lots of the stores, versus Myer where they sold the property and leased it? That's always been a bit of a debate in investment circles. So happy to include gross profit over ROA if we see it falls well in isolation. But I'm always skeptical about using assets as a divider in the ratio equation.
Okay, interesting. I haven't gone through the Novi Marx paper, so I don't know what they found.
I'll get GPT to go through it and tell you.
Well, it already did tell me that it was the thing.
Yeah, what did it say? What that method, that metric for loans, or what kind of CAGR over what period?
Yeah, no, I didn't go.
Okay.
I didn't go into that. It just said that it's one of the best documented metrics in academic research. for determining performance. I'll drill into it some more, but I guess the real point of that is I think we are the AIs are at a stage now where I can engage them to help me do deep research on some of these things and start to build testing systems to isolate different metrics at a new level and look for things that we might be missing and play around with them. So I'm going to start trying to set aside some time to do some more of those things and see what we come up with.
Right. Well, speaking of AI and metrics, the one I'd like to put into QAV is buybacks. Companies undertaking buybacks. And the only way I've been able to tell that is to do a text search in their announcements or in their own annual reports. So I know you're doing work on looking for qualified audits. Perhaps when that's at a production stage, you might be able to look at doing a text search for buybacks as well, because I'd like to put that into the checklist.
Okay.
And in fact, I was going to talk about it a bit later. I might as well bring it up now. There was some research I came across reported. This was in the AFR last week. And there was some analysis that showed the majority of ASX-listed companies that announced buybacks have outperformed the broader share market in the subsequent 12 months by a median of 10%. So I think it is worth putting it in. I wanted to put it in on the basis of O'Shaughnessy's research in what works on Wall Street. So but it probably needs to have a search through the announcements for companies to look for the word buyback, because I haven't found a database of buyback information anywhere to search.
Yeah. Yeah, I've got to keep trying to build some sort of system that can search for those and give us an updated report on it. It's difficult. More difficult than it should be. Okay. Well, I'll work on that. Speaking of checklists, one of our members, Peter, told me that he downloaded the latest version of the AF checklist and it was giving him an out of resources error. And when I opened it up and played with it, I got the same thing, but I was able to isolate it to a sheet that I added at some point, which was a Josephine checker sheet. Once I removed that sheet, which isn't really necessary because it's in the buy list that I put out each week, I think I built it in that and then moved it over to the buy list. Once I removed that, the out of resources error went away. So just a tip for people out there, if you're getting the out of resources error on your AF version, delete that sheet if you're not using it and see if that removes the problem. It's just it's too many formulas that Excel can't handle. I'm still trying to get my US version checklist to stop giving me that error. I've been optimizing it, and I keep getting it. I haven't quite figured out the solution yet. But I have done a new version of the AF sheet 25.3, which I'll put up in the club member resources page, which will not have that sheet in it, the Josephine checker. Hopefully you won't get that problem with it if you don't want to take it out of your own. Let's talk about Ingham's Chicken, ING, Tony. They came out with their results. They dropped 20%. I had to sell them out of a couple of portfolios. So I was going to hold on to them because they're a big company and you had the thing, and then about holding on to them. And then I went back and read through the transcript from our amusing show and you said it's just amusing. And I was not amused by Ing, so I sold it. Their share price has not recovered either. I thought it might. They dropped from $3.55. They're now $2.79. But when I look at their 5-year chart, they did this last year and the year before. Their results come out. They drop by a substantial amount. Then they recover. Then they come out with their results and they drop and then they recover. And part of me did think, oh, I'm just going to hold on to them and they'll recover. But then I thought, well, it's, that's not the rules. That's forecasting. And B, it's the opportunity cost. I could be investing that into something else. But what do you think about those sorts of patterns when company like this comes out with their results, drops, then recovers, then repeats? I mean, I think there's CCP, CCA Credit Corp is one of those.
BCP.
CCP, yeah.
Well, they are of late. Historically, they haven't been, but yet Ingham's been a bit of a disappointment, I think. It has all the hallmarks of a good value stock. But as you say, it just cycles between a reasonably narrow range of share price movements, which tend to go sideways. So it hasn't really progressed, which is kind of strange because I would have thought with all the cash they're throwing off, they should be able to consolidate the industry. Perhaps they can't do that now because they own so much of it, and the ACCC will get interested. The latest downgrade, I think, is as much about its results. Well, it is about the results, but it stems from the Woolworths contract reducing with them. I don't think they've lost the contract completely, but Woolworths are going to bring on other competitors as well. And so it's disappointing. I know they've turned over their CEO a few times in the last few years, so that's also not a good look. But yeah, I just can't. I can't understand this company really. I think it should be doing better than it is. But given the fact that it's moving sideways, I'm happy to not invest in it, to sell it once it goes below its sell line.
Oh, well, it is well and truly gone below its sell line. That's why I sold it.
Yeah.
The sell price is $3.06. It's currently $2.80. Scott, in our questions, he brought up ING. He points out, so the Woolworths contract is now reducing the amount of chicken they can sell to them and pressuring margins as they're now selling more on the wholesale market. Did they sign the contract in the last week? No, it was in February, 5 months ago. If so, why not announce that at the time? Got any insights on why they didn't tell us back in February?
No, and they should have. If they didn't, I'm not that familiar with the company. I haven't followed it for a while because it's disappointed me once too many times as well. But yeah, that sounds like a material disclosure they should have done. It also highlights one of the problems with the business. If you are a supplier to one of the large supermarkets, you generally don't dictate the terms they do. You're a price taker. But I do know from the pulled pork I did on Ingham's a few years ago is that they were also a big supplier to the restaurant markets, the fast food markets. So they have been trying to diversify away from supermarkets. And I would have thought, I mean, every analyst that covers this company or covers the industry says when cost of living is difficult, this company should do well because people drop from steak to chicken, right? Because it's cheaper. And they drop from eating out to fast food takeaways like KFC. But doesn't seem to be flowing through to Ingham's for some reason. Again, I wonder about the management of Ingham's, given all the good things we can say about it.
I'm looking through announcements on Stock Doctor back in February. Nothing I can see here about the Woolworths contract. On the contrary, in May, 6th of May, they did a reaffirming FY25 guidance and trading update that said Ingham's Group provided the reaffirming FY 2025 guidance for poultry volume growth of less than 1% to less than 3%, an underlying EBITDA of 236 million to 250 million. Group core poultry volumes declined 2.2% in the first 9 months compared to the same period, blah, 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 blah. And the share price was up 2.2% after that came out. So apparently there was nothing in that shocked the market. And then they come out with the full results and the share price drops 18.63%. So
yeah, if they provide guidance in May and they don't meet it in June, that's pretty poor, I think. And Scott makes a good point. All I can suggest is he goes and talks to a class action lawyer about taking on this company over their disclosure habits, because unfortunately the great phantom in the sky, the ASX, will probably do nothing about this sale.
Well, it's not one of our stocks, but we do hear it talked about a lot. CSL.
Oh, yeah.
No, I'm moving on.
Yeah, fair enough.
CSL. How many times have we heard about what a great company CSL is? Great company,
Well,
great Australian company, great stock.
it's come across our desk twice now, Cam. We think we had members of was it the Sydney Value Investing Club? I
Yeah.
think it was them. It I shouldn't attribute it to them because I can't be sure. But I thought we certainly had someone on who spoke CSL as a value stock on the basis that they thought it was going to be worth more in the future and you could buy it at value now, even though it's always been seen as a growth stock classically by investors. And of course, it definitely was part of the Rudy Philippek Van
Yes.
Dyke all-weather stock portfolio. He came on
Yes.
in the early days of QAV and spoke about CSL and how great it was. Well, all I can say is the all-weather stock portfolio is probably going through a snowstorm at the moment. And I've got a quote from Rudy. He says, "I can confirm it almost hurts my eyes to see CSL shares trading on $2.14. My mind goes, dude, you're looking at the wrong ASX code, surely."
214, not $2.14.
Sorry,
$214.
$214. You're right.
Yeah.
Yeah. So I feel sorry for him, but it's history repeats. It's if you buy something on a high PE ratio, yes, it will go up for a while, may go up for years, but when it crashes, all that high PE ratio disintegrates quickly.
I've got an interview with him from a year ago, August 2024 on Livewire, where he said its time to shine was now. Rudy is extremely bullish on the outlook for CSL. He argues that CSL's time to shine is now, and that the stock could be on its way to $400, if not $500 a share. I want to point out that when we had Rudy on, probably 5 years ago, it was trading at about January 2020. It was trading at $312. It's now $215, so it's down nearly 30% since then.
Yeah.
So
look,
yeah,
I don't want to pour scorn on Rudy. He picked the wrong stock, and that's we all do.
Yeah, you do.
No, I don't, because he's a fellow traveller who's out there trying to educate people in how to invest. So, I actually would encourage people to go and check out his methodology for creating the all-weather stock portfolio. It's a neat idea. I disagree with him at the time. I disagree with him now. If you buy a highly overvalued growth stock, irrespective of how good the business is, at some stage it will hit a speed bump and the growth premium will disappear. And they go up the staircase and down the elevator quicker than value stocks or most other stocks in the market. So it's a salutary warning for all the people who are out there buying the growth stocks on the ASX or in the US. Now the same thing's going to happen.
It dropped from $271 when its results came out to $213 last week. And I was pretty spot on with my guesstimate about when he was on. It was the end of January 2020, 31st of January, season 2, episode 4. And it says, Tony, also in this episode, Tony discusses the effect the Wuhan virus has had on the ASX and our portfolio this week. It's back when we were calling it the Wuhan virus. Good times.
The Wuhan clan.
Yeah. Before it just became COVID, it was the Wuhan clan. Well, that's all I've got in my list of things apart from questions. What have you got, TK?
Well, a few things. We've spoken about a couple of the stocks which haven't done so well out of reporting season, but I wanted to cover some of the ones that have done well. So, Auto Sports Group, ASG, been on the buy list for a while. A stock site analysis site called TipRanks says Auto Sports Group Limited stock movement is primarily driven by a reported 8% increase in revenue, despite a significant 46% decline in profit due to acquisition expenses and amortization. The company's recent control over BS Stillwell Motor Group is seen as a potential positive factor. And Tip Ranks reports year-to-date price performance 65.5%. And despite this, ASG is still on the buy list. So it's done well, seems to be driven by acquisitions, and it's a car dealership aggregator, so it makes sense. And anyone living in Melbourne will know Bib Stillwell's Motor Group as being a large dealership in Victoria. So ASG has done well since reporting its latest results. Pepper Money, which I think has been the top of the buy list, if not one or two, for most of the year. They reported their numbers recently, and their year-to-date price performance is up 58%. And Pepper Money have said prime residential and commercial mortgages rose 171% over the first half of 24-25, accounting for 70% of new business at Pepper Money. By contrast, non-conforming lending now accounts for just 30% of new originations, down from 60% in the first half of 24. Strong demand for prime mortgages and asset finance has bolstered Pepper Money's loan book growth according to its half-year results. For the 6 months to June 30, the non-bank lender revealed total originations rose 38% on the prior corresponding period, reaching 4.5 billion. Applications were also up, increasing 10% on the prior half and 30% on the year prior to 6.8 billion. New mortgages across Australia and New Zealand jumped 53% to 2.8 billion and 21% compared with the second half of 2024. That's reported from a company called the Advisor, another analyst site. So, great results from Pepper Money. And they've rejigged their businesses away from lower quality loans in favour of prime lending. It's also strengthening the business. And the last one to talk about is Perenti, a stock I own, and one of my favourites. And I looked at the stock graph this morning, and it's almost vertical since the results came. So it's really powering on. And Australian Mining, website that follows mining companies, says Perenti has powered through the 24 financial year with a record, FY25 financial year with a record-breaking result, including a record $333 million in underlying earnings before interest, taxes and amortization. Revenue hit an all-time high of $3.49 billion, up 4% on FY24, driven by growth in drilling services and another steady contribution from contract mining, etc., etc. EBITDA up 6%, margins up 9.6%, NPAT 8%, statutory NPAT 29%, and a lot of extra free cash flow, which has meant net debt has been reduced to $300 million. And they've increased their dividends. So year to date, Perenti's up 51.6%, according to Yahoo Finance.
I've got that and a bunch of portfolios. It's been in the dummy portfolio since May of last year. It's up 121% since then. So yeah, it's done very well. Of the other ones you mentioned, who'd you do before then? PPM?
Pepper Money and all those stocks.
Yeah, PPM we've held in a couple of portfolios, a dummy portfolio, a light portfolio, since May of this year, up 30% in each of those. And ASG I've had in a light portfolio since May of this year as well. It's up 48% since then. So doing very well, some of those stocks. Nice work.
Yeah. I know you haven't done a portfolio update, but the light portfolios seem to be starting to find their feet in terms of CAGR.
Yeah, I'll do that. So we have the 4 light portfolios that all started at different times. The first one, which started just as Ukraine invasion happened and interest rates started going up, is still not underwater. It's up 5.4% since February 2022 versus the benchmark up about 10%. So it's half as good as the benchmark. But the second portfolio is 15% versus 9.5%. It's up. The third portfolio is up 14% versus 12.7% for the benchmark, and the fourth one is up 18.5% versus 12.5% for the benchmark. So as a group for the four portfolios, according to the Vex's methods of calculation, the group is up 14.5% versus the benchmark up 11.8. The dummy portfolio, if I go back to, if I do the 5-year thing, dummy portfolio is up 17.7% for 5 years versus the benchmark up 11.6. And in the last, like 1 year, the dummy portfolio is up 30% versus the benchmark up 16. So
Yeah, it's been a good year.
gangbusters. The US portfolio, while I'm here, we'll do that when we get to the US show. But for the 12 months, the US portfolio is up 22.2% versus the S&P 500 up 14. So the dummy portfolio in Australia is outperforming our US portfolio over a 12-month period. So go figure that, because the US portfolio, the US market is completely bonkers. For all time, which for reference, I started it in September 2023, the US portfolio is up 73.8% versus the S&P 500 up 44.9. So doing quite well. But somebody at Kung Fu asked me today, so what are you doing for the rest of the day? I said, I'm recording a couple of investing shows, one about the Australian market, one about the US market. And he said, which is better to invest in? I said, doesn't matter. Doesn't matter. If you know what you're doing and you have a system, it's all the same, right? Really?
Yeah, it's been my experience.
Yeah. So there you go. So
All those results are good. Speaking of the US market, I did note, I think it was Friday of last week and for the weekend and Monday of this week, the market's kicked on because Mr. Powell, the Fed chief, spoke at Jackson Hole, and he talked about the fact that, I'll try and find the quote for you. Where is it now? He basically talked about, here we go. The balance of risks appears to be shifting, Powell said. While labour markets look stable, it is a curious kind of balance that results from a marked slowdown in both the supply of and demand for workers. That has led to an unusual situation in which the risks of worse than expected labour market outcomes are rising, he said. And if those risks materialise, they can do so quickly in the form of sharply higher layoffs and rising unemployment. So he's come out and said, market's looking risky, or the economy's looking risky. The share market went up a couple of percent. In fact, the article I'm quoting from the Wall Street Journal says that the Dow Jones Industrial Average, the S&P 500, and the NASDAQ Composite all finished Friday with the gains of roughly 1.5 to 2%. So the Fed chief is cautioning that America's looking dicey in terms of its economy. The market goes up because everyone's hoping he'll cut rates. It's through the looking glass, I think, sometimes with the way the market reacts to the Fed's announcements.
Yeah, bonkers. Oh, bonkers.
Yep.
What else?
I came across something on Facebook, a meme that said, "Nothing says productivity like 28 people in a meeting." I thought that was quite funny. About the productivity council last week.
Uh-huh. Yeah.
Yeah, so that's all I've got. I've got a pulled pork to do, Cam. You've got nothing else?
Well, yeah, I think Scott's other questions, I think you've sort of covered. He asked if we could do a review of results across the buy list stocks that got a nice bump or a big drop and why they were punished, rewarded. I think we've done some of that. Anyway, we'll keep doing that as we go over the weeks. He says he's sitting on cash due to the no buying during reporting season rule and wondering if I top up current holdings, PPM, for example, on the back of good results, whilst culling a couple of not so good, which will free up some more dollars to invest, looking at UING and OMG. Well, you should have already sold ING if you're following the 3-point trend line rule. I can't remember. Where's Media? I think I did. I sold them. No, they're the OMG. They're OML. Who's OMG? Oh my God. I think he means OML. I'm guessing. They are down for me, but they're not a sell yet. Although their 3-point sell is kind of vertical. It's $2 and they're at $1.67, but I was in the black on them, so I held. I'm down 2% on them now. I don't know. Should I sell?
Should you sell? I'm not going to give personal financial advice.
It's not personal. It's QAV advice. It's not my portfolio. It's a QAV portfolio. It's one of the light portfolios. It's a management decision.
If it hasn't triggered a sell line, then you should keep.
No, it has.
Well, then
So,
sell it.
oh my God. So, we've got a few stocks, and this was one of them. TPG's another one, where the 3-point sell line is vertical. And so it was sort of outpacing the stocks. And TPG, for example, I've asked you about this before, and you sort of concurred that we shouldn't sell. TPG, I'm up 6% on it, even though its sell line is $5. Sell price is $5.65. It's currently at $5.27, so it's below the sell line. But it's up 6% from when I bought it, and the share price has been going up. It's not that it hasn't breached the sell line because the share price has been going down. It's breached the sell line because the sell line is going up because it came off a low during the last market crash, right? So it was one of those. I haven't. It has been going down though in the last month by the looks of it. It's dropped a bit. OML is another one that was in that situation, but it's gone backwards a lot, and I'm now in the red on it. So
I think both of those two are sells.
Yeah, right.
From the classics, sort of below the sell line approach. I understand what you're saying now about it's rising quickly, so the sell line's tracking along its low points, but the low points are rising quickly.
So what about COG Financial Services? Because it's the other one that's technical 3-point sell. Sell price is $1.87. Its price is $1.73, but I'm up 26%. And again, it hasn't really come back a little bit from where it was at the beginning of August, but it's the share price has been going up consistently since February.
Sorry, what's the code? Was it COG?
Yeah, COG.
Let me have a look. Great.
I've been making exceptions for these, but I think those other two I probably should let go.
Yeah, I agree. Yeah, I think you should probably hold. If it was me, I would hold on to COG, and its month on month is still slightly higher. And that means that in a couple of days, it's the 26th of August as we talk, there'll probably be a new L2 and the share price will probably be above it.
A couple of days. So what you're saying?
A couple of days, yeah.
A couple of days.
Yeah.
Anyone old enough to remember that? Just us? Hold on. Sell ING and OML. Take care of that. Thanks for confirming that.
And all back to Scott's questions, he should have enough stuff in Stock Doctor now to find something to buy. But I'd certainly be happy to buy more of Pepper Money the way it's going.
Lindsay Australia, he says he reviewed their results presentation, and whilst the current position is not awesome, it looks like they're still well positioned to bounce back once the new business they have acquired recently are bedded in. They are back to about what I bought them for in April. So do you guys think they're worth staying the course, or is my interpretation way off?
Yeah, I mean, again, we got rules for selling, and LAU's above its sell line, and it sounds like it hasn't triggered a rule 1 for Scott yet. If it was me, I'd be holding on to, not trying to predict how long it takes for positions flow through to the bottom line or any of that kind of stuff.
Yeah, I hold LAU in 3 portfolios, Scott. The dummy portfolio and 2 parcels in 1 light portfolio. I must have doubled up on it at some point. I've held it since June of 22 in the dummy portfolio. It's up 57%. August 22 in 1 light portfolio, up 38%. And September 22 in another light portfolio, in the same light portfolio, second parcel, it's up 15%. So, it hasn't shot the lights out in the last 3 years, but it hasn't breached.
Yeah.
Yeah, it's come down a lot. It was, wow. 2020, mid 2023 was $1.35. So it's 66 cents. Now it's halved over that period of time, but I haven't sold it.
So yeah, not giving Scott personal financial advice, but the process is to wait for it to be a rule 1 or a 3-point trend line sell, and not trying to wonder too much about the underlying business and what management are doing and what acquisitions they're making, etc.
Yeah. It's still on the buy list, by the way, this week. So that means the checklist is still saying it's a buy where it is today. So if it hasn't breached a sell line and a sell trigger, and it's still a buy, the fundamentals are still good. All right. Who are you doing a pulled pork on, TK?
MA Financial.
I knew you were going to do that.
Because you read my notes.
No, I didn't. I don't read your notes. I like to be surprised. I'm like,
I'll stop sending them. I'll stop doing that.
Yeah, that's all right. Yeah, no, I want to be surprised. No, because I hadn't seen them before. I had to check them for a qualified audit when I saw them on the checklist on the weekend, because I hadn't seen them before, and I thought, yeah, Tony will do them because they're new-ish.
And they're a reasonably large stock too.
That surprised me. Yeah, they've got a big ADT.
Yeah. ADT of 1.3 million, which is good. So MA Financial, people may recognise the name Moelis Group. They changed their names to MA Financial a few years ago. It was called Moelis. And Moelis, some listeners may also recognise as being a large US financial firms. They do have the license to do business with Moelis in Australia, and for a while they use their name. And one of their directors is Ken Moelis from the US. So he has a stake in this company in Australia too. So there are linkages back to the US company, even though this was set up by a couple of Australians who still remain on the board. So MA Financial, who are they? So stockbroker, investment manager, asset manager, lending broker in business, and corporate advisor. So kind of covering the waterfront there for financial services. They have they operate under a number of different brands. They own a mortgage broking brand called Finsure. They manage hotels under the brand name of Red Cape Hospitality. And that came about after they set up a fund called the Red Cape Hospitality Fund, and then decided that managing some of those hotels was a good idea and a good way of maximising the returns in the fund. And the Red Cape Hospitality Fund has over $1 billion invested in Aussie hotels. They're a non-bank lender with a brand called MA Money. They have a brand called Middle, which is some kind of technology that allows brokers to quickly gather client information and to transfer it quickly across to lending providers. And they have a retail consultancy and shopping centre manager brand called Ret Pro. So I guess they've evolved to have a finger in a number of pies. They say themselves that they're a global alternative asset manager, specialising in private credit, real estate, hospitality, unique operating assets, and private equity and venture capital. And they also manage traditional asset classes, including equities, bonds, and they have 12.7 billion management. So they're reasonably large, and they are what they call themselves as active managers. So they not only invest, but they also, where appropriate, directly operate and manage many of the real estate and hospitality assets, including hotels, marinas, and shopping centres. They originate and manage many of the loans in their credit funds. And so their mantra is that they believe that in-house hands-on management and expertise results in better risk management and stronger long-term performance of the assets they invest in and manage on behalf of their clients. Their mortgage marketplace, they call it, has $155 billion in loans available from over 80 banks. I'm going to say available on loan, and non-bank lenders, and they represent 3,700 brokers and 400,000 customers, roughly. So, reasonable. It's a pretty large mortgage broking business, and they also provide loans directly through their MA Money platform. They kind of started out in funds management, but also evolved into corporate advisory. And their corporate advisory business in Australia is called woes Australia. And they provide financial advice for clients across mergers and acquisitions, strategic advisory, and equity and debt capital markets, capital restructuring advisory, equities research and trading. And they say that they operate as the exclusive partner in the Australian market for New York Stock Exchange listed global investment bank, Moelis and Company. So they began back in 2009 amidst the shadows of the global financial crisis. They commenced in Australia as a corporate advisory business, Moelis and Company, and they were in partnership with the Moelis and Company in the US. And they rebranded to, first of all, Moelis Australia from Moelis and Company when they listed on the ASX in 2017, and then changed their name to MA Financial Group in 2021. And was done to reflect the broadening of their business activities since founding as an investment banking partnership with Moelis and Company. They started off in Sydney in 2009 with just 5 employees, and they now have over 700 people and over $100 billion in assets across multiple classes. They talk about one of their key strengths is employing highly experienced and motivated staff, but critically, their people share a strong alignment with our clients and shareholders by owning approximately 40% of the company and co-investing in many of the managed funds that MA offer. So that's the company. Latest results were quite good, which is what's driven the share price appreciation recently, but also the fact that their new numbers put them on the buy list, whereas the old numbers didn't. So the latest results showed business growth across the group. For the first half, underlying revenue was 26% up, and so was EPS growth on the first half in 24. NPAT was 22.6 million, and EPS was 14 cents, and they were both up 27 and 26% respectively on the first half in FY24. And they claim that since listing at $2.35 in 2017, MA Financial has delivered its shareholders a total return of 19% annum. The MD went on to say in the results announcement that underlying EPS in the second half of 2025 is expected to be materially higher than in the first half, and they believe that the group is in great shape to deliver strong earnings growth into the future. So that those results put a bit of a rocket under the stock price recently. Looking at the QAV numbers, stock price is $9.12 at the time of the analysis, which is slightly under consensus target, about 12% below consensus target, but above our IV1 and IV2. IV1 is only 81 cents and IV2 is only $3.34. So a bit of a difference there between what we think value is and what the consensus target is. But I think what's happening is that the people who are following this company are factoring in large earnings per share growth in the near term, and we're a bit more conservative. Company's yielding 2.19%, so it is paying a dividend, but not scoring well enough for us to put a tick on the checklist. Net equity per share is $2.22, and I note the net tangible assets is below that, so we can't buy this stock for anything like book value. So, at least on our sort of conservative measures, it's looking a little bit overvalued. Stock Doctor Financial Health and Trend is marginal and recovering. So marginal as financial health doesn't score for us, but recovering scores a 2. And I like stocks that are in the recovering financial phase. They tend to do well. I went through the Stockopedia results and the numbers weren't looking great. And I'll just quickly cover them. They rank a quality, the quality ranking is 37 and the F score is only 3 out of 9. But when I drilled down on it, I think the Stockopedia numbers haven't been updated for the latest results, and it still looks like they're using 2024 numbers. So if anyone's using Stockopedia out there rather than Stock Doctor as their feed, just check to make sure you've got the right 2025 numbers before you score it. So I'm kind of parking the Stockopedia numbers for the moment. PE ratio is 57 times, which is the highest in 3 years, so we give it a negative on our checklist for that. prop cap though is it's only trading at 4.4 times the operating cash flow, so strong operating cash flow at the moment.
Wow.
I did notice, like this is a financial firm, so sometimes it can be affected by inflows and outflows, which it looks like this company can be. But in the operating cash flow line, there was a interest income line which is going up a lot, and I think that's what's driving the operating cash flow. So I think that is legitimate income in it from a business point of view, rather than rather than fund inflows and outflows, which is driving the prop cap. Earnings per share growth is forecast at 102%, which means that it scores for us on EPS over PE. Even though the PE is high, we still get a score of 1.78, and our cutoff for a score is 1.5. The other thing to like about this company is that the directors hold 36% of the stock. So two of the founding partners, Christopher White and Andrew Pridham, are both on the board. Christopher is the co-CEO. Andrew Pridham is one of the co-founders. He holds 8.5%, and I can't remember what Christopher holds, but it's around the same sort of amount. So they're both still holding a bit. Ken Moelis from the States, from the US Moelis company, sits on the board, and he holds 16%. So large ownership of founders. The Moelis group in the US is down as holding 10.2%. I couldn't quite work out whether that was incorporated in Ken Moelis' 16 or separate, but either way, there's still large holdings between owner founders and the US Moelis company as well. This company doesn't have consistently increasing equity, so we can't score it for that. But overall, quality score is 10 out of 15 or 67%, and the QAV score is 0.15, so it scores reasonably well for a large company. Some of the strengths I like about it: large shareholding by owner founders. I would think the link with the US Moelis group has to be a positive, apart from the fact that there's a lot of experience that they can draw on. There's probably also a lot of network linkages that they can make, which would help them. I like their model of being both an investor in assets, but then also operating it themselves. I think that gives them hands-on focus, quick ability to improve operational efficiencies, but also, I guess, another income stream from that same investment. So I like that model. There's also been a large growth in private credit over the last few years and in the mortgage broker market. And we're seeing that in a number of companies on the buy list. We spoke about Pepper Money before, who are also playing in that space. And it does seem like the major banks in Australia have ceded a large part of the lending model to other players, and Moelis or MA Financial is capitalising on that. On the risk side of things, I mean, you can't go past the risk for going to be there for anything which is funds management based, which is just basically that the market is in overvalued territory and will probably correct at some stage, but who knows when. So there's a kind of normal market risk for this company as being a fund manager. The other thing that I wanted to highlight, I don't know whether this is the start of a trend or a temporary thing, is that a number of the red cape competitors in the hoteling industry are starting to report decreasing sales. Endeavour Group came out recently and said that their sales were down. I can't remember the other one I was looking at, but anyway. And there has been some reporting that that there is a general decline in the take-up of alcohol usage by younger people in particular. So I'm not sure if that's a trend which will affect this company over time, but they certainly have other strings to their bow besides hotels. So that's MA Financial Group. It looks like a good addition to the buy list.
I read a report the other day that said young people are drinking less, smoking less, and having less sex.
What's changed?
And that the three were connected. Well, the three were connected, it said.
Oh, really?
Well, people aren't going out drinking as much. So, apparently if you don't go out, you don't get laid.
Well, I was about to say my daughter doesn't drink much, but I don't want to comment on whether she's getting laid as much. She doesn't go out much either. I don't know about your boys. But
no.
It does seem to be a thing with young people these days.
Taylor's going out all the time in LA, but Hunter not so much.
Yeah. I don't
But
think
I've
Taylor's
talked
much of a
to
drinker, though, is he?
no, neither of them are
Mm.
drinkers. They both have learned from family experiences.
Hmm.
That they are very cautious with the booze. They drink, but just keep a very very tight lid on it. Yeah. Um. Well, after hours then, Tony. Thank you for that MAF
Yeah. So after hours,
sat.
we spoke about Yarrawonga, um,
Oh,
which was a lovely trip. We're lucky with the weather too. It was quite nice, even though the temperature was saying it was like 5 degrees in the morning. We were still getting around in our shirt sleeves. It was hotting up. It didn't feel like a cold day. It was lovely. We had a horse run on Sunday, Lake Forest, which missed the start, so didn't do too well. But
what's that mean? What does miss the start mean?
no, I
It
played
turned
up in
up
the
late,
barrier.
got stuck in traffic. No what?
Played up in the barrier, and then when all the horses jumped, it didn't. That was
Oh,
it came out
really?
last from the
You've got one
barriers.
job, horse.
Exactly. Or jockey.
Is it the jockey's fault? Like, who gets the blame for that?
Oh, it can be the jockey's fault, but I think in this case, it played up in the barriers. It was just bad timing. The starter is supposed to keep an eye on the horses and not start the race until all the horses are settled and ready to go. But if we were
Right.
rearing in the barrier and then the barrier doors open, we missed it.
The horse is just like, no, not feeling it today. Don't want to be here. Don't want to be in this thing. Why have you got me locked into this little booth? Let
Could
me
be,
out.
could be all sorts of reasons. Could be got a bit of a niggling injury. Could be that it's just overexcited, doesn't want the jockey on board. Who knows?
Hmm.
Gets excited, like it's ready for competition, and starts to rear and buck and all sorts of things.
Hmm.
We ask them and they never tell us. That's a David
Give
Hayes.
AI a few
That's a
more
David
years.
Hayes line.
Oh, really?
Yeah.
Okay.
Why did the horse run so slow? Well, I asked them and never told me.
Nice.
Uh,
What else?
been listening to your catch up with David Markham, which was really nice on the bullshit.
It was nice.
Mm.
And I'm hoping he'll come on this week. He said he'll come back, and Ray and I are supposed to do a bullshit filter this week. So I'm hoping David will be able to come back on and we can do more politics stuff. But it was really lovely to catch up and have a chat with him. I haven't
Yeah.
spoken to him for a couple of years.
I haven't listened to the whole thing yet because it goes for about an hour and a half. But I had a chuckle to myself. I think probably in the first 10 minutes you said about 2 words and David spoke non-stop. So there's a very different cadence to interviews with David, which took me back to Napoleonic times.
That was when my podcasting started. Just ask
Mm.
David a question and then sit back and relax for an hour or two.
Yeah. But I recommend
Yeah.
this. It's great to hear the catch up.
I was like, he's doing well. As he said, he turns 80 in December. And speaking of people who turn 80 or are 80, oh man, the Who are touring at the moment. What's left of them, Pete and Rog. I read an interview with them in the New York Times yesterday, which was talking about, this is the 15th time they've done it. This is our last tour, and whether or not they're going to work again and all this kind of stuff. And then I saw on YouTube, people have filmed the entire concert. So I went and had a look at one. I was in Newark, just like from, I don't know, a few days ago. Sensational. Like Roger
Really?
Daltrey is 81 and he hits every note. I expected him to do what McCartney does, which is pull down a register occasionally when you've got a really high note. No, he goes up. He pushes it further than he did when he was 35. His voice is amazing. And Pete on guitar is just as amazing as he ever was. He's not as, his windmill arm isn't
Yeah, right.
windmilling as
Yeah.
us. And Roger twirling the mic, he starts at the beginning and kind of flubs it. And then he has a chuckle to the audience. But in terms of performance, unbelievable. For men in their 80s, unbelievable. They are the new rock gods. I mean, the Stones are probably hitting that as well. And, as far as I know, they're still kicking it. But Mick, love Mick, but Mick's not Daltrey. Like, Mick doesn't, I'm a midnight rambler. He does a bit of a Bob Dylan and you
Right.
can't always get what. It's not like singing Who Are You or Pinball Wizard or, any of those tracks. Like, Daltrey really had to sing and he can still do it. It's just, he reminds me of Russell Mail from Sparks. who's, I think he's 76 or 77, and he still hits really high notes. Everything, like his vocal performance is insanely good. His brother Ron is 80. Like they're up there as well. Those guys still doing 2-hour shows every night. Russell's bouncing all over the stage, hitting every note. That's man, like this generation of rockers that have been going for 50, 60 years in the Who's case. 60, 64? 64, I think their first album came out.
I went to the Who Turns 50 concert when I was living in Toronto. That would have been probably 10 years ago or less. Yeah.
So Entwistle would have been gone by then?
Oh, Entwistle
I think
in the 90s.
Yeah.
Yeah.
Really? Okay.
Yeah.
Right.
He was about 50 years of age when he went.
Man.
Did you notice if Zach Starkey was still playing on drums? Because I know he was sacked, but I thought there was some talk he was going to be reinstated.
They sacked him, they reinstated him, and then they sacked him again. Oh, okay. That was part of the New York Times article. They're like, what's going on? And actually, Pete had a good line. He goes, he was never my favorite drummer. In fact, none of our drummers have been my favorite drummers. I didn't even like Moon. I didn't like Moon as a drummer. I'm like, who couldn't like Moon?
Really? If you get a chance, go and watch the Isle of Wight concert. It'll be on YouTube. It's probably only about half an hour when the Who were playing. But something happens. I think it might be Entwistle's amp blows. And so there's just Moon and Pete left. And they goes on for like, I don't know how long, 5-10 minutes, where Pete will play something on guitar and Moon will echo it on the drums. And then Moon will play something on the drums and Pete will echo it on the guitar. And they just have this amazing rapport going back and forwards. It's
fantastic.
It's incredible. Yeah.
I had a friend over, one of Fox's school friend dads, who's a heavy metal rock guy. I have his kid comes over from school. Chrissy brings him home on a Thursday afternoon. I look after the boys. He finishes work late and comes and picks his kid up. And by the time he's gone home, I've always got something on YouTube. Usually it was like the Aussie tribute concert, or I'm watching something, and he and I sit there, and or it was a Go-Betweens documentary or something like that. We're always talking about music. And I had a Who concert on from like the 70s, and we got talking about it. And I said, have you seen the video, the official video for Who Are You? I think it's Who Are You? He goes, no. And I goes, oh, mate, you got to see this. Keith, like just Keith in the official video. He's got his headphones gaffer taped to his head, as he often did. But just the faces that he's pulling, like the camera's really up close and he's doing his drum solo or whatever he's doing. And, after the, in I think it's Who Are You, when it sort of breaks down, the song breaks down and the synth comes in, and then Keith comes back in, and it starts building up. And, dun, 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 and he's just like, he's just going nuts, pulling monkey faces, and so entertaining. So he's entertaining. Great. Yeah. I love Mooney.
That was in The Kids Are All Right, wasn't it? And he's there rolling his arms.
Yeah. He does that in this too, when they're all singing around a mic doing the
that's from The Kids Are All Right.
Oh, okay.
Yeah, great documentary.
After we spoke a couple of weeks ago, I watched The Man Who Fell to Earth on SBS.
Okay.
And I'm now reading the book that it was based on. I didn't know this, but the guy who wrote that book also wrote the book that The Queen's Gambit was based on, the Netflix series that blew up a few years ago. He also wrote the book that The Hustler was based on.
Oh, okay.
The Paul Newman film, and the sequel, The Color of Money. He wrote those books as well. So he was quite a prolific science fiction / apparently he was a major drug addict and gambling addict, and so he wrote books about what he knew. And The Man Who Fell to Earth is quite good. But yeah, the film really held up well. And I'd forgotten Rip Torn was in it. And I loved Rip Torn. He was like one of my all-time favorite American actors. And seeing here a young Rip Torn in it, well, kind of middle-aged Rip Torn, I guess, but before all of the stuff that he did in the latter part of his career, Larry Sandler's The Gary Shandling Show, and Larry Sanders Show, Gary Shandling, and Men in Black and 30 Rock, and he had a great late part of his career. But I remember I saw him not long ago. He was in Steve McQueen film where he's the poker player, the Cincinnati Kid.
All right.
Rip Torn is sort of the number one guy that he needs to play in that. He's like some Texan with his drawl and whatever. Yeah, great actor. Anyway, so thanks for telling me that was on SBS. That was great. I really enjoyed it.
Yeah, so
And
did
then
I.
I saw a Leonard Cohen documentary on SBS after that too, which was fantastic. It's all about Hallelujah, the song Hallelujah,
Mhm.
and how the album that he wrote that for, he famously wrote like 180 verses for that song over 10 years. And the final version had 5 or 6 verses. And then he'd do it live and he'd do different verses. But the album that was on, the label, I can't remember which label it was, Columbia Records, I think, refused to put the album out. They said the album was terrible. They hated it. There weren't any good songs on it. And they refused to put it out, even though they paid for it to be recorded. So it ended up coming out on some little 2-bit label and didn't sell. No one bought it. And that was it. Leonard thought he was done, thought his career was over. And he was in his 60s at this point. And then they talk about how that song, somebody did a tribute album to Leonard Cohen, and John Cale picked that song and did a version of it. And then one of the women who is the producers of the Shrek film loved the John Cale version and wanted to put that in the film. They actually had it re-recorded by some younger dude, but the John Cale version ended up in the film anyway. And then Buckley, whatever his name was, Jeff Buckley.
Jeff Buckley, yep.
Before he was anyone, he was playing at this little club in New York, and somebody said he was looking for songs to play, and it was kind of like, just throw songs out. And somebody said he didn't know the Leonard Cohen version. Somebody gave him the John Cale version, and he did his own version of that. Everyone loved it. It was on the album. He died before it came out. Then it became a huge hit. And then everyone on every American talent show, like America's Got Talent, whatever, there was always somebody doing the Jeff Buckley version of Hallelujah. And at one point, 3 versions of it were in the top 20 in the US. There was some America's Got Talent star who had done it, the Jeff Buckley version. They were number 1 and 2, and then Leonard's version was like number 20 or number 18 or something.
Well, Katie Lang covered it too. I think
I saw her do it in a tribute concert to him after he died too, which was great. That's actually the film finishes with her doing it live, which was a stunning performance. So they're just talking about how this song, the label hated it, wouldn't even put the album out, and then it just got this massive life. And then they talk about Leonard's career. I mean, the whole thing's about Leonard's whole career and how the last chapter of his life was just amazing. He was so beloved, and it's amazing. Really great documentary.
I'll look it up. Thanks.
It was on SBS. Yeah. So thanks for putting it on SBS. A lot of good stuff. Yeah. And I've been reading a good book. I've been reading Zhang Wei. He's a Chinese scholar at Fudan University on China. He's got a couple of books on China's economic and political model. There's the first one from 2012 I'm reading. It's called The China Wave. His sort of breakdown on the China model, similar to the one that I read by the Canadian scholar Daniel A. Bell a few years ago. But it's him sort of breaking it. And this guy's like, he's an advisor to Xi Jinping, and I think he was an interpreter for Deng Xiaoping when he was younger. So he's been in the upper circles of the CCP for most of his life, but he has a great way of just explaining why China does it the way that China does it and why it works, in his opinion, why it has worked so well, why it continues to work, and why the West doesn't understand China's model. It's like, listen, we've been doing things our own way for 3,000 years. You guys come along and think you know how to do things. We've been doing this for a long time. We've just integrated the best of all the things that China's been doing for 3,000 years. And, we're back on top, baby, and we know how to make this work. So just sit back and watch. So
I saw a great
yeah, it's
quote. It was in a
mm,
review of a book about China and comparing it to the US by a Chinese person who had spent a lot of time in China, but then was studying in the US and spent time there too. But the quote was great. It said that the difference between China and America is at the heart of the Chinese economy are engineers, and at the heart of the US economy are lawyers. I thought it was a very good
interesting.
summary. Mm.
Yeah, but he just talks about the political model, the social model, and the business model and the economic model, and how they work in China, and how, as we've talked about before, you're allowed to be a billionaire, but you're not allowed, as a billionaire, you're not allowed to have any control over the political system. We'll let you be a billionaire, but don't think you're going to have any say in what happens politically. And as soon as you get too big for your boots, you get taken to a little room and re-educated about
Sounds
how
like the
things
US at
work.
the moment.
Yeah, it does actually. Yeah, very much so. Speaking of which, time to go do our US show.
Yeah.
All right.
Well, it's been a good week
Today,
for me anyway in the market. So happy ASX, everyone else out there. I know not everyone's done as well during reporting season, but hopefully enough people have.
yeah. Well, I think generally speaking, if I look across all of the portfolios that I run, they all seem to be doing
Mm.
well, except my super. My super's not doing well. I think it's
Oh,
up like 6% in the last 12 months. So, oh, actually, no, that's not true. I realized that I hadn't kept Navexa updated with my trades, so I have to update my trades. I'll edit that out. Forget that. I'll
okay.
report on my super next week. Thanks,
All
TK.
right.
Have a good
Okay.
one.
You too.